Hello and welcome to Morning Trade on Moneycontrol. I'm Stacy Pereira, filling in for my colleague Nandita Khemka. But I'm here to help you navigate through this trading day, give you actionable trading ideas, strategies, the sectoral trends that are doing the round, and most importantly, your queries that we will be answering through the course of the show. So guys, do keep commenting on our live feed and we'll have them addressed by our guests on the show. But before we get there, let's see what's making headlines and also what we're getting from the global handover. Now, it seems like stocks have slipped on Wall Street as the Fed Chair Jerome Powell says that slower economic growth will be needed to bring down persistently high inflation. He indicates that the rates are not too high at the moment, but that has pushed higher treasury yields, also putting pressure on equities. And Asian markets too have opened lower after that Fed Jerome Powell's hawkish comments. The GIFT Nifty is also implying a lower start for the Indian markets. And if you look at crude, fears of the Israel-Hamas war escalating into a regional conflict has pushed oil prices higher. Brent has surged over 1.5% to trade above the $93 per barrel. And FMCG majors Hindustan Unilever has reported a steady second quarter, although its volume growth came in at just about 2%, which is marginally below estimates, whereas ITC reported a strong internals with cigarette, FMCG as well as its hotels verticals beating estimates. The cigarette volumes, we learn, grow about 6 to 7%. Now, those were some of the top headlines, but let's see what's in store for today's trading day and what are the key points that we're going to be looking at for the technical analysis. More importantly, what the charts are telling us to give us those levels. Let me bring in Kush Bohra, the founder of kushbohra.com. Thanks so much, Kush, for joining us this morning. Let's just get a sense of what we're looking at. We've seen 2 days of a weak trade, one would say, or rather range-bound trade for the benchmarks, and no good positive cues to really take that forward also, or to build that momentum at this point. So what would be your likely levels that we could be watching out for the Nifty as well as the GIFT Nifty? The GIFT Nifty already showing us a negative start. So give us levels that we could watch out for the Nifty as well as the Bank Nifty this time.
Sure. First up, Stacey, a very good morning to you and a very good morning to all the viewers. And thank you for having me on the show. Well, see, what we're looking at is a very clear range-bound Nifty. And by range-bound, I mean the range is a bit broad here, 19,500 to 19,800. And if I just push for the extremes, then 19,450 and 19,850, that's the range that we're looking at. Now, as long as the Nifty is in this range, we could see what we call a time-wise consolidation. It could move sideways. The market really wants to go up. We've actually crossed 19,800 twice on the closing basis, but not by much. And then, the next day we gave up. So I think, here the test is going to be 19,800, 850 kind of zones on the upside. But if we break 19,450, then we're looking at, September lows again, which was close to 19,200, 19,250. So I'm looking at this level of 19,450 to be held. Right now, the setup suggests a buy on dips, kind of a scenario. Because, you buy on the downside of the range, but you also have to remember to sell on the, higher end of the range. So that's what I'm looking at on the Nifty. Bank Nifty for me is a bit of a concern because now, we're looking at what about June lows that, the Bank Nifty had hit. We're very close to that now. So if, those levels are taken out, which is, 43,200, where incidentally the 200-day moving average also lies, then we could slip a little lower. But this is also making a case for a short covering on the Bank Nifty. So it's a very delicately placed index right now. So Bank Nifty, I would avoid. Nifty for me right now, as long as the range is protected, would be a buy on dips and a sell on rise. I'd just play the range on Nifty.
Right. So playing the range is what will perhaps work, especially for the indices. And in Kush also saying that Bank Nifty, because we've seen that kind of swings coming back to those June lows, maybe it's a wait and watch game there. But I'm also going to ask Kush to wait a bit and, till we get to answer our queries from our viewers. But let me then get a sense of the fundamental picture. And since we are already in the thick of earnings, we're seeing a lot of external pressures that are actually changing things on grounds for the markets. And since there are no big positive cues either, we did see overnight in the US where the treasury yields really surged with the Federal Reserve's chair Jerome Powell, who went on to speak and went on to say that monetary policy is quite going to be worrying, in fact, and that interest rates would probably stay higher for longer. And this has actually got the bond yields in the US to surge to new record highs, this time crossing that 5% mark as well, and which is what we're going to see play out in trade today. So let's understand how these shocks are going to be absorbed and get that global picture and the ramifications that the Indian market is going to have on the overall fundamental picture. And to do that, joining me is Aishvarya Dadheech, the founder and CIO of Fident Asset Management. Good morning, Aishvarya. Also, I already laid out the picture. We've seen what cues that we are getting from overseas. Most of the markets, that negative stretch perhaps is going to continue for even the Indian equities. But if you have to look at the other headwinds that we're seeing, is it just commentary from the Fed, or is it actually going to be these bond yields that are really changing the equity game as well? Give us your take on that.
Good morning, Stacy, and good morning to all the viewers. Thank you for having me here. Obviously, yesterday's comment of the Fed chairman has created, I would say, the hardening of the yield across the yield curve. If you look at from as low as 1 week to a 30-year period, majority of those yields are either cross 5 or closer to 5%. And obviously, it will have a ramification impact on the equities across the globe. That is what we have seen, that especially the European market, if you look at, they're at almost at a 7-month low on account of the slowdown in the growth as well as the rising yield across the curve. So obviously it has an impact on equity market. But what is really important for us to understand that it is just not the yield which is impacting the equity market. There are other factors at place also. So there is a fear about slowdown in developed market growth alongside China. And at the same time, we have all this geopolitical risk which is ongoing. So your hardening of yield curve, your geopolitical scenario, your the slowdown fear is all impacting the global equity market. But in this context of all of that, if you look at India's market, you will be surprised. You won't be surprised to see that India's is the best performing equity market in the last 6 months. And that's the reason for that, because if you look at the data, all the high frequency indicators, all the macro indicators of the Indian economy, right from GST, from PMI, from credit growth, the fiscal asset side, inflation, majority of them are reporting a very, very, I would say, conducive environment for equity. And as you said, we are in the thick of this quarterly season, and so far, I think more than 100 odd companies, relevant companies have reported numbers with almost 12% kind of a year-on-year revenue growth and almost 20% kind of profit growth, providing a very important stimulus for this market to stay healthy. Obviously, we have seen a lot of IT companies reported numbers which were on a weaker side. If you look at the various other sectors, the business season has been pretty, sanguine from that perspective, which is giving the much needed support to the Indian market. But obviously, this geopolitical risk, which is hanging on all of us, if it escalates, we will not be surprised to see this, create much more havoc on equity market across the globe. Last but not the least, if you really look at, the two important data which I'm personally looking at to see whether this geopolitical risk will really go off the roof. One is the crude oil prices, and another is the yield curve. Obviously, we are seeing that in the last 1 month, both crude and crude prices has inched up because of this geopolitical risk. But we are not seeing any, I would say, drastic movement in that kind of scenario. We are not seeing crude going off even a 1 month or 1.5 month high from that perspective. If you are entering into more, I would say, bigger issue from geopolitical risk, we won't be seeing US 10-year yield at the current situation. So we be very watchful of this. I think none of this has been overplayed. This geopolitical risk is there, obviously, for sure. But some sort of investors, the smart money is not thinking on those lines, Stacey.
Right. Well, talking about inflation in the US, which always has those kind of implications even here, but the inflation is something that even our FMCG companies are really have to keep an eye out for. And we saw a slew of FMCG earnings that came out yesterday from HUL to ITC, and all of them did show that there is some bit of recovery. We wouldn't say that they were fantastic numbers. They have held steady, we could say, for the second quarter at least. And they've shown some bit of improvement in their volume growth as such in the lower single digits, if you have to call it out. If you have to look at how brokerages are viewing them, well, on ITC, Morgan Stanley has now put an overweight call for them, and they're giving it a target of about 493 per share. So there are a couple of segments within these FMCG that have really worked, be it agri or paper, that has not worked for ITC, whereas the cigarette business, as always, being that pushing the numbers for ITC. Whereas if you look at HUL, that HUL did see its food and beverage business, that one take a dip in its EBIT this time around. So let's look at the overall picture for the FMCG sector as a whole. Now that we do have inflation to be watching out for, we are definitely seeing it ease, and we're seeing that little bit of recovery even in the rural demand. So will that really play out, and is now a good time to be looking at FMCG stocks?
So, Stacey, after the debacle in IT, I think FMCG looks really nice comparatively, right? We saw the result of Nestle and HU, Hindustan Unilever alongside ITC. Couple of things which has come out very clearly is that, as you spoke about inflationary trends, that obviously the growth side we have not seen a very strong set of numbers. Obviously ITC has given a decent set of numbers, even Nestle reported decent numbers, but due to rural side, we have seen HUL's volume growth were much lower. But what really excited us is the way how they have expanded the margin across all of these three companies. If we also look at the CPI inflation numbers, which came very recently, there's a very clear trend that the inflation level is getting moderating, and we will possibly see this margin expansion continue as long as this growth is also supported in the coming quarters. So to answer your question short, looking at the way market is positioned, and very, very, I would say that limited avenue of investing across, FMCG could be one of those safe haven for investors from current perspective, because we expect these companies to report anywhere between 12 to 18% kind of an EPS growth, supported by high gross margin expansions because of those moderation in inflation. And at the same time, the way market is positioned, it's much more, I would say, safer bet to invest into FMCG names. We don't expect very strong growth in the staple side over the next 2 to 3 quarters. If one has to look out for growth, one has to look out for the discretionary side. If you have seen a place like, say, shoes, or possibly travel, or even if we look at PVR format of when they reported their numbers yesterday. So discretionary side is something where possibly we will see high growth because of a strong festive season. But staples, because of the rural side, might continue to not see very strong growth in the coming quarters. But that will be more or less offset by the margin expansion which you will see in the FMCG space.
Right. So you're saying discretionary stocks, those are going to be the ones that play at least for this festive season and, going ahead. Let me also get your quick view on the pharma sector, because we've seen a couple of M&A activity in that whole space, and we have a couple of earnings that we are leading into. So your quick view on how one should be looking at the pharma sector right now.
I think pharma looks very attractive at the current juncture. The valuations of pharma are very, very, conducive from return perspective. And at the same time, the base effect of pricing in US look like have been more or less done. And at the same time, when we are looking at the way US FDA is looking at approvals, we can clearly see the leniency coming out through. And as you spoke about a lot of those acquisitions which are happening, provides a lot of comfort from private equity sides and all of those players which have this confidence on pharma. And pharma has been a laggard for many, many years right now. So we are very positive on pharma, but we are very selective in that particular space. We still prefer pharma which has more exposure to India rather than US. And at the same time, we also prefer a lot of and API players right now, because we have seen that the kind of issues these companies have faced over the last 2.5 years are now on the back of the anvil, and we believe a lot of these companies will come out very strongly on numbers. We have heard a lot of these companies have signed good contract with various of these non-US kind of geographies, which will convert into higher revenues for them over the coming times. And also the the stabilization of the commodity prices will help their margins in the coming quarters. When majority of these companies are trading at a very, very attractive valuation of close to 20 times to 25 to 30 times, which were earlier trading at almost 35 to 45 times. So we believe there is value proposition in pharma, in the API space, in the CDMO space, and even in large formulation player based out, which have high exposures to the Indian market.
Well, right. Aishvarya, Dadheech, we'll leave it at that for now. Thanks so much for giving us your time this morning. But also, let's get some queries and answered from Kush Bohra. But before that, let me tell you which stock is on my radar today. I'm also looking at Tata Motors specifically. That's because after a very long time, they've gone ahead and acquired a 27% stake in Fright Tiger. Now, this for a whopping 150 crore rupees. The group has also entered into this share purchase agreement, and this is if I have to tell you exactly, they're going to be acquiring 26.79% in this logistics solution firm. Quite out of the blue that we are seeing an M&A that also coming in from Tata Motors. Yes, we've seen a couple of EV plays that have come in before this, but for them to be looking at a logistics solution, where in all that does this fit in? Well, we are going to try and figure out how that really came about. But what this deal also enables Tata Motor to do is to further invest about 100 crores over the next 2 years into this Freight Tiger investment that they've come in. Kush, this is of course news that is coming in, but if you have to look at the auto space as well, because in the past 2 days, those are the ones that are really stepping on the pedal. We have those earnings also still in store, but we did have Bajaj Auto, which came out with a good set of numbers when it did. Now we are hearing of a new deal brewing in this space. So how is one to look at auto as a sector, and also which are the good stocks that one could be looking out for in this space?
You're spot on that. The space has been doing well. If you see, there was a bit of a consolidation. In fact, in the most in most stocks, the likes of Maruti, Tata Motors, even Ashok Leyland for that matter, the two-wheelers were the ones that were doing well. Again, Escorts, the likes of TVS and Bajaj Auto now, they've been doing well. So we've seen the run up in them, but I think it's time for Tata Motors and Maruti Suzuki to again take the lead. We've already seen some sort of an uptrend here, so I think this could continue. So Tata Motors, Maruti Suzuki are the two that I have on my radar. Any kind of dip, a meaningful dip in these stocks would be, a buying opportunity for me. So I'm looking at both of these. Also, if we are looking at some of the other, ancillary names, the likes of, JBM Auto and the ones are the ones that should be on your radar. But that is from a, investment perspective, let's say 6 to 12 months kind of a time frame. From a more near-term momentum kind of perspective, look at Tata Motors and Maruti Suzuki. Both of them have given a breakout and are sustaining.
Kush, we're also getting a query from Trilok, who's asking us your view on M&M, and he's asking for the short as well as long-term view. So how should one be looking at M&M?
So as we said, the auto space is picking up. Just that, M&M had a stupendous run last year, and then it's just gone into a consolidation mode. If you look at the last, 4 to 5 months. So for me, M&M will perhaps remain in a bit of a tight range. So from a near-term perspective, I think the upside could perhaps be limited to about 1600 kind of levels, and on the downside, we're looking at, 1525, 1530. So this could perhaps be range bound. Even the momentum indicators are suggesting that, it could remain in the range for some time. So I would pick, Maruti or Tata Motors over M&M from the near-term perspective. From the medium to long term perspective, I don't see an issue. This consolidation is actually healthy after the kind of sharp run up we saw from 1100 odd levels all the way up to 1600. This consolidation is actually a buying opportunity. So if you want to accumulate from, let's say, 6 to 12 month perspective, then Mahindra & Mahindra is not a bad stock. From, as I said, a near term perspective, I would pick Maruti and Tata Motors over it for now.
Right. So Mahindra & Mahindra, more of a long-term bet at this point. Hope that answers your questions. Let's look at some other queries that we're getting in, especially on Adani group of stocks. Now, there is Sai Prasad Dharekar who's asking your view on Adani Power, as well as Rajesh Sharma who wants to know on Adani Ports. Now, they are two diverse businesses, but how is one to look at Adani Group? They've seen quite a bit of swings, we could say, in this whole time now. Although, in the run-up to their earnings, they perhaps do pretty well. So how is one to be looking at the Adani group of stocks?
Stacey, interestingly, if I were to pick two stocks from the Adani stable, these are the two that I would have on my radar. They'd actually move a lot higher, a lot faster than, the big one, the Adani Enterprises stock. So these are the ones that I have on my radar for sure. It's just that, as you said, leading up to the numbers and in line with, the kind of market dip that we are seeing, both of these stocks have dipped. So I would wait for any kind of a fresh entry. If I look at Adani Ports, right, 785 is a very strong support zone, but the key averages are, it's trailing below its key averages, and the momentum indicators are suggesting, further downside. So I would wait. A good entry point would be close to 775, kind of levels. So Adani Ports, that's the number, that I'm looking at, 775. As far as Adani Power goes, this was in a bit of a, better position and, continues to remain so. We've seen a bit of a bottom at about 325 and the stock's rebounding from there. So this could perhaps turn out to be, a better trading bet, at least compared to Adani Ports. On the upside, we're looking at 360 and 375 kind of levels. And on the downside, as I said, 325 is where I would place my stop loss if I were to take a position on this. So Adani Power, slightly better place than, Adani Ports at the moment.
Right. Let's also shift focus to a couple of other stocks that are going to be a buzz. One of them will be Zomato. Now, this is coming on the back of news that there is likely to be another block deal that we are going to see today, and SoftBank looking to offload more shares and more stake in the company. Now, we have seen them in terms of, do this before, and how that really took the stock and that rallied quite a bit. So any kind of, action that we could expect in Zomato, and how is one to be viewing it, because we've seen quite a run up in that stock?
You're right. We've already seen, the stock practically more than double. Their stock was languishing at 50 levels, and that's not too far ago. I mean, that's just about April when the stock was at 50 levels, and it's actually more than doubled from those levels. Now, if I look at the stock on a daily chart, then there's something called a negative RSI divergence. That is suggesting that perhaps the near-term trend could be at least flattish or consolidation, if not downward. But if we look at a slightly longer term, chart, then actually it's making a rounding bottom, which is suggesting that there is more upside left. So I would wait for a dip. Any kind of dip close to about 100 or 105 odd levels is a buying opportunity for me. The overall trend is very much intact here. The stock could see 130 and 145 levels in the coming week to months time. And on the downside, I would have my stop loss close to 95. So buy on dips is what we suggest on Zomato.
Right. So we're going to have to wait and see whether this news actually brings the stock lower, and then buy on dips is the suggestion that Kush has for Zomato. But also let's look at the banking space. Now, we've seen how banks have really performed quite well off the few earnings that we've seen. HDFC coming in quite comfortably, we could say, for the second quarter. We do have ICICI that will be putting out its results on tomorrow, and Kotak and the others as well. So how is one to be viewing the banking space? In fact, we have a couple of queries too. Sai Kumari is asking your view on Federal Bank as well as IndusInd, which came in yesterday, as well as Pooja Mehta wants to know your view on Axis Bank. So these ones being the private banks at this point, how is one to be looking at them?
Very, very cautiously. because a lot of these names were actually due a breakout. If I just talk about the big ones, ICICI and HDFC, they were due. At least HDFC was about to take support and rebound from there, but we've seen it give up gains post the numbers. At least we can call it that the ship steadied. So as long as 1500 is held, HDFC could perhaps hold. As far as IndusInd Bank goes, the stock's actually given up a lot of gains if we see yesterday. So 1465 is a resistance zone. I wouldn't get into a buy trade in this one until 1465 is taken out. The other stock that you mentioned was Federal Bank. Here too, the trend is largely on the rise, but given the fall that we've seen in the entire banking space, this could also witness some selling pressure. So 148 is a level that I'm looking at. Beyond that, I would go for a long trade in this one. And lastly, Axis Bank. Well, this is one stock that we actually like from the private banking space. However, even this has gone below its 20-day moving, its 50-day moving average. So I would wait and watch. So a lot of these names are very close to the support zones, right? So if I have to pick one from the momentum perspective, it would be Axis Bank. And 980 is where I'm looking at, in terms of a support zone on the upside. 1010 and 1025 are the levels. So among the three, Axis is one that I will have as my momentum play. HDFC, if 1500 holds, then perhaps is a good time to get into an SIP kind of an investment for, let's say, 12-month kind of a horizon.
Right. And Kush, before we let you go, please do tell our viewers which would be your stock picks that they could also look out for. What do you have on your radar?
Given the market scenario, we've got a mix kind of a trade. One of them is Scient. The stock's actually be doing rather well, and it's not really participated, in the market fall. So I would suggest, Scient is something that I have on my radar. 1825, 1875 are the levels on the upside, 1725 on the downside. Biocon, that's one stock that has actually sort of given up all the gains that came about some time ago, and it's below its key averages. So 230, 222 are the levels that we're looking on the downside. 240 is where I would place my stop loss on a short trade. So these are a couple of stocks that I have on my radar. Scient from a long perspective, Biocon from the short side.
Right. Well, thanks so much for that, Kush, and thanks to all our viewers who've been sending in their queries. If they weren't answered, don't worry. We'll be back on Monday morning and to do just that, to answer all of your questions. Thank you so much, Kush Bohra, there for giving us his perspective as well as stock picks and strategies that you could use in your trading day. Well, with that, it's a wrap on this edition of Morning Trade. But stay tuned for more. Coming up next is Opening Bell.